The air feels different today, whispers across crypto circles, the kind that usually comes before something seismic. XRP ETF approval, no longer a fantasy, but a timeline waiting to unfold. Analysts, traders, and even traditional funds are circling, sensing the undercurrent of momentum that's been building since the SEC softened its stance. Every candle on the chart now looks alive, breathing, watching, anticipating, because if XRP gets its ETF nod, the ripple effect won't just stay in crypto. It'll sweep across the broader markets, liquidity flows, institutional capital, retail FOMO, all aligning like clockwork, a perfect storm forming under our eyes. XRP standing as the bridge asset once doubted, now validated. The ETF narrative isn't just about price, it's about legitimacy. The moment the ticker XRPE flashes on Bloomberg terminals, the world changes, the perception shifts, and suddenly those who mocked it will wish they had bought at these levels. This is the prelude, the calm before a breakout that could rewrite altcoin hierarchies forever. And yet, amid all the noise, precision is power. Not all trades will shine equally. Some will soar with the ETF wave. Others will drown under volatility. This is where strategy matters, where foresight separates winners from watchers, because when institutions move, they move silently, strategically, positioning months before headlines break. So what are the 5 trades to consider, and which 3 should be avoided at all costs? Trade number 1, accumulation, the obvious but often hardest to execute. Building gradual exposure to XRP in staggered entries, using fear-driven dips to strengthen positions, because once ETFs go live, prices won't look back, liquidity will tighten, spreads will widen, and panic sellers will regret their short-sightedness. Trade number 2, infrastructure plays, exchanges, custody providers, and bridge protocols directly benefiting from ETF-driven volume, companies and tokens tied to liquidity rails, think Flare, OneChain, and wrapped assets on institutional rails. This is where utility-driven gains outpace speculation. Trade number 3, derivatives exposure. Leveraging XRP perpetuals or options before volatility spikes, using controlled leverage with strict stop losses, because implied volatility will surge once approval drops, creating massive opportunities for traders who read the volatility curve instead of chasing pumps. Trade number 4, liquidity pools, staking, and DeFi routes tied to XRP pairs, especially those integrating stablecoin rails. This is where yield-seeking institutions might quietly park capital for arbitrage and passive exposure. Watch decentralized liquidity deepen as ETF-backed demand rises. Trade number 5, macro rotation. This one's about cross-market movement, reallocating out of overbought Bitcoin or Ethereum dominance into undervalued alt sectors, where XRP sits as the prime beneficiary of capital rotation once institutional ETFs spread beyond BTC and ETH. This rotation play could amplify XRP's dominance cycle. But now, let's be brutally honest, because 3 trades must be avoided. The first is chasing microcap illusions, small projects tagging themselves as XRP partners with no real ties, designed to attract hype during ETF mania. These are liquidity traps waiting to implode. The second, over-leveraged long positions, because volatility doesn't care about your conviction. And ETF news could trigger both fake breakouts and flash crashes before the real move begins. Leverage kills faster than fear, and in ETF cycles, it's the silent reaper of overconfident traders. And the third, neglecting macro risk, ignoring Fed policy, dollar strength, and bond market signals, because ETF-driven inflows still compete with global capital cycles. And one hawkish surprise from Powell could deflate even the strongest narrative short-term. Balance your exposure, hedge your euphoria. As we inch closer to potential approval, XRP sits on the edge of validation. The digital asset built for liquidity, now potentially about to anchor institutional capital flow. This isn't just about a ticker, it's about timing, infrastructure, and insight. The window before confirmation is narrow, and this, right now, is where the legends position themselves. As retail waits for headlines, smart money is already moving, whispers of filings, adjustments in trading desks, liquidity partners preparing rails, custodians finalizing agreements, everything aligning behind the curtain. XRP, once a speculative token, now the foundation for cross-border ETFs. The noise will rise, influencers will scream to the moon, but the real traders will stay quiet, focused, executing, because they know when the ETF bell rings, it's not about hype anymore, it's about flow, about money entering pipelines that can't be easily stopped once opened. And when that happens, XRP won't just move, it'll reprice, recalibrate, reset global perception, and every chart you've ever studied, every prediction you've ever made, will feel like a prelude to this one moment, the dawn of XRP's institutional awakening. Markets breathe in anticipation. Whispers swirl like smoke before a storm. Every analyst, fund manager, and on-chain watcher knows it now. The moment XRP ETF approval becomes reality, the liquidity dynamics across crypto will never look the same again. Billions in dormant capital, sidelined and waiting for regulatory clarity, finally ready to flow. The ETF isn't just a new product, it's an institutional greenlight. A permission slip for capital to engage, for risk managers to allocate, for balance sheets to diversify, and XRP, the token once chained by legal uncertainty, now stands as the cleanest, most fundamentally ready bridge asset in the digital economy. This is where understanding structure, psychology, and timing separates profit from regret, because ETF-driven markets aren't driven by retail hype, they're driven by flows, and flows obey math, not emotion. So if you're watching XRP right now, you need to understand the deeper mechanics beneath the charts. Think about it, ETFs are liquidity engines, they buy and hold, not trade and flip. Every inflow, every subscription, every creation unit adds pressure to the buy side, locking supply, shrinking circulation, creating scarcity, and XRP, with its fixed supply, feels that compression faster than almost any alt. This is why analysts call it monetary torque, the effect of institutional liquidity tightening around a finite digital asset. Every dollar flowing in has an amplified impact, and once ETFs go live, the torque turns exponential. Imagine this scenario, early inflows of $1 billion, $2 billion, maybe even $5 billion within the first month. Sounds insane until you remember that Bitcoin ETFs drew tens of billions in weeks, and XRP, being cheaper and cross-border utility-driven, becomes the institutional hedge against BTC volatility, the liquidity stabilizer inside the broader ETF ecosystem. And that's where the 5 trades truly take shape, not as guesses, but as positioning strategies. Trade 1, accumulation through controlled cost averaging. The professional method isn't by the dip, it's phase allocation, distributing capital across volatility ranges, absorbing liquidity when fear spikes. Because ETF rumors will cause chaos before clarity, whales use chaos to feed, retail uses it to panic, the winners know which side to stand on. Trade 2, exposure through liquidity infrastructure. Companies building rails around XRP ETF markets, think custodians like Coinbase Custody, think liquidity providers tied to RippleNet integrations, think tokenized debt rails using XRPL for settlement. This is where ETF demand creates real-world revenue for the supporting ecosystem. Trade 3, volatility arbitrage. Professional traders use implied volatility premiums before ETF events to profit from option spreads, delta-neutral setups, and gamma squeezes, while retail buys narratives. Institutions harvest volatility. This trade requires precision but can deliver asymmetric returns when executed ahead of announcements. Trade 4, staking derivatives and yield products tied to XRP exposure. DeFi will replicate ETF demand through synthetic liquidity, tokenized ETF exposure, wrapped XRP variants yielding passive returns while mirroring ETF inflows. This parallel market mirrors what happened with wrapped BTC during institutional inflows in 2021. Trade 5, macro rotation, the silent but most powerful move. Because institutional capital doesn't enter randomly, it rotates, exits overbought assets and enters undervalued ones. BTC and ETH will absorb first flows, but the second wave, the smart allocation, will seek asymmetry. Assets with real-world usage and undervalued risk-adjusted profiles. XRP fits that blueprint perfectly. Now, while these trades position you to capture upside, remember the 3 to avoid. First, the hype trap, chasing speculative projects tagging themselves to XRP or ETFs with no legal or technological link. We saw this during the Bitcoin ETF boom. Fake ETF tokens surged 300% and vanished. The same pattern will repeat. The same victims will scream. The same manipulators will cash out quietly. Second, the leverage delusion, retail traders stacking 10x, 20x, or even 50x longs before announcements.